So good to have you on Tax Conversations. This is our summer series. I'm so excited. As you can see, I'm able to stand today. Oh, this is so good. So welcome everyone. Welcome in. Woo! You see, when I get here, I get so pumped up. I need to calm myself down because it just gives me so much joy to be able to share what I know. It's so sad. I should chill. I should chill. When I say sad, as in I should not be this excited. But welcome to Tax Conversation. This is our summer business and tax success series. If you have been following this through, thank you for giving me space in your head to share a little bit of what I know. And hopefully, you're picking something that is able to transform your business and what you're building. Okay, I'm Dr. Lilly Mbinglo. I am a licensed CPA in the beautiful state of Virginia, but I serve clients all over the US. And I'm an accounting professor as well. I teach at Regent University. I teach accounting for the Masters of Accounting program as well as the MBA program. So this is near and dear to my heart, sharing knowledge, the ability to share what I know. So hopefully I can impact what you're building and help you just gain more clarity in whatever you're deciding to do. So if you've been following this week, my favorite topic. Okay, actually, we always do two topics. If you've been following, you will see every time I come on, I cover two topics just because, everything speaks differently for everyone depending on what kind of business you're in. But today we're going to be talking about business partnerships. I can never get enough of business partnerships, but we'll also be talking about how to audit proof your business. As a matter of fact, that's where I'll be starting because when it comes to staying in compliance with IRS, and not just the IRS, but also state agencies, documentation is everything. And I think a lot of how important it is to keep track of everything that they're doing until they get that letter from the IRS. Anyone here who has gotten an audit letter? That stuff will make your stomach to ache. You'll be like, what in the world is happening? But when you get that letter of the IRS saying, we need more documentation, we need more support, if you have not been tracking your records, right then and there, you're about to lose your mind, right? But that should not always be the case. And I'm hoping that by the end of this session, that you will have a good understanding of the kind of things that trigger an audit and hopefully walk through with me in putting a system in place for your business to ensure that if it ever came to that, you're good. Okay. And by the way, getting audited by the IRS does not mean you did anything wrong. Okay. Let's get that out of the way because sometimes when people get a letter of audit, it just breaks their spirit. And they're like, oh, I don't think I even want to do this business. No, getting audited just means we want more support. Want more documentation. Sometimes it might be the first time that you're filing a tax return with your business. And the IRS is like, okay, we've not seen this information before, give us something. Sometimes they're just errors, right? Genuine errors that happen, and they're like, this does not match. This information is not informing. You understand? So we need more from you. Getting audited does not mean that you went out of your way to do something illegal or to do something wrong. It just means they want more documentation. And if you're able to provide that, that means you were ready. You generally would get out of this without losing your mind. But if you are not ready, that's where it can be such a, an annoying, well, let me not say annoying, but such a mental, a very stressful process. Okay. So let's talk about it. What are some of the things that would trigger an audit, right? Because when you hear people are getting audited, you're always wondering, like, what's the cause of that? And you can imagine, it sounds like it's a very random process, but the IRS usually starts with the help of their systems. Okay. So what does it mean, or how does it even happen? When we file taxes generally and we send taxes to the IRS, the initial process of your taxes getting processed is done by machines, right? Like computers, and they are very intelligent systems that will match things up. So if you file your taxes as an employee, generally when your documents go to the IRS, and we're reporting that income you had, they already have something that your employer had filed. And so what they're doing initially is they're matching up this information. And if it's pretty straightforward, it gets processed, it gets approved, you're getting your refund in no time. That's it. Now, if you're a business owner, because your stuff is slightly different from like an employee that has had someone send information for you. In your case, you're the one who is likely reporting your income and expenses if no third party has reported your income. If a third party has reported your income, there'll be a little bit of that process. But when you send in your stuff, the IRS is kind of going through, matching your numbers to people or businesses in your industry or with similar incomes like yours. Okay. So when you have those little things that stand out or that send red flags into their system, your taxes will get flagged. Like, okay, come. Wait, this is not making sense. Doesn't necessarily mean something is wrong. It's just saying we would love for you to substantiate this information so it makes sense given your revenue, given your industry, and the other players in your industry, that your numbers are not in alignment, right? So that's kind of how this works. So I put together a couple of areas that will trigger an audit, and I want you guys, if you're following today, before we talk about how to audit proof, to know some of these areas. All right. The first one, which I think everyone, if you've been someone who files business taxes, whether you did it the right way or you went and you were cooking your books with someone, is usually large losses year after year. Okay. So you started a business, you incurred some losses, the IRS gets it. When you start a business, you generally will incur more expenses than what you're bringing in because nobody knows you, you're still building. So we should expect to see some losses. But if year over year, you're reporting significant amount of losses, well, the first thing now is this person really in this to make money, or is this a hobby, right? Generally, the IRS will want to see you making a profit, like, 3 out of 5 years. I don't always say that to entrepreneurs, especially those that I know that are working really hard in their business and struggling to make a profit. I don't want you to feel like, oh, because I'm not making a profit, I should not report my expenses. You should still report your expenses. I mean, look at Amazon. How long did it take Amazon to become profitable? The whole idea in this is the IRS wants to know that you're actually, and actively pursuing a profit. Like, you're not just doing this for the fun of it. You're actually in this to make some money. All right. Oh, guys, I like standing and doing this. First of all, shout out to my husband. He was able to help set my walking desk, my high desk. So I'm like feeling myself. I'm so excited because now my desk is up here. I'm short, but when short people have the opportunity to feel tall, we don't play. All right, jokes aside, let me go back to this. Okay. So the first thing is, if you're reporting large expenses year over year, you're opening yourself up for, some questions. All right. The next thing is, if you have perfect numbers, like rounded numbers. I mean, there's no business that can tell me that their rents were exactly $10,000 and their taxes were exactly $2,000. Like, all your expenses are just perfect numbers. Now, it doesn't mean every now and then you might not pay a bill that is a perfect number, right? As in a rounded number. But the IRS wants to make sure that you're not out here estimating your expenses. Because when they see that, it's like, okay, this looks like they're being estimated. Now, if you have an accurate bookkeeping system, between me and you, it'll almost be impossible to see perfect numbers like that unless somebody wrote a check like $10,000. That's a perfect number. That's rounded, right? But that was a check. Generally, if you're doing transactions where you have to use a card, there's taxes involved. It's impossible for all your business expenses to be even numbers, like rounded numbers. Guess what? That's an area that could trigger an audit. Now, am I saying it's impossible? No, but for all your numbers, though, I think that's impossible. So if you're one of those people who is just estimating your expenses, I would say you want to be careful with that, right? Because the IRS wants to make sure that you're not just estimating, but that you're actually going through the right process of tracking your relevant business expenses and reporting those. Okay. Then the next area that triggers is usually where you have excessive deductions compared to your income. Now, don't get me wrong. The first point I said, reporting large losses year over year. That is where your business might be treated as a hobby over, being an actual business. Okay, that means you're in a legit business, but back to back, the IRS is concerned that are you in need for profit. But you have now people that report certain significant expenses that don't align with their income. Okay, so for example, if you make $2,000 selling products online, but then you report that you took out clients to business lunch for $25,000, something is wrong with that. You see what I'm saying? That's a business expense that doesn't align with the income that you're making. So in cases like this, it's definitely going to trigger an audit. Now, is it possible? Yes, maybe you hosted an event and you spent a significant amount of money hoping to bring in sales or something, but it should make sense, okay? So sometimes if you have, crazy deductions that don't really align with your income, yeah, the IRS is definitely going to have to ask you some questions like, okay, please come, let's talk about this. Okay, that's my third area. My fourth one for you is when it comes to your business use, the business use of your car. If this is a car that you also use for your personal stuff and you report that you're using it 100% for business, most of the time it's going to trigger an audit because you're using, if you have a separate car that is just for business, then that's 100% business, okay? But if you're using your personal car and you're claiming that you're using it 100% for business, they're going to come for you, right? Now, if you are actually using your car for business, you definitely want to make sure that you are keeping track of your mileage or your gas or all the relevant expenses that you incur for maintaining your car. And we're going to talk about that, okay? And then the next one, the fifth one, is large cash transactions, where you make either large cash purchases or something where the IRS comes and you just, you show a large, amount of, something that you incurred, you paid for out of pocket with cash, or, when you're in a business that is constantly collecting cash. That's always an area too that could trigger an audit, right? Just because cash businesses, they're very interesting. I'm not pointing fingers, but it's very easy for people to avoid paying taxes when they are receiving their payment in cash because the IRS cannot track it, versus people that use a third-party system like a Square, or have a credit card processing machine that will send a report to the IRS, or and send a report to the business owner, and so the IRS kind of knows what you're bringing in. Think of people who do Uber. Uber has a record of everything that you've made, right? So when you're dealing with when your business is highly involved in using cash, sometimes that could cause a lot of interest. So in your case, you definitely want to keep a lot of documentation, right? Because that could easily trigger an audit. Doesn't mean you shouldn't have a business that is high on, is using cash. I mean, if your business, people want to pay you cash, what would you do? Just make sure that you're recording it, okay? Another area now, the sixth one that gets audited a lot is the home office deduction. See, the home office deduction is a very legit business deduction. And I hope that every business owner who has a home office is taking advantage of it. But you see, the problem is many people don't know how to document this right, and that always leads them into getting audited. So the home office deduction is one of those deductions where once you do your measurements right from the get-go and you can keep your stuff, IRS is good. So an audit does not mean that the IRS is going to disallow your deductions or they are trying to just audit your deductions. They are just more concerned about the documentation that backs up this deduction. All right. So if you're one of those people that works from home, you have a home office, it's very important that you're keeping the right documentation for that. And I'm going to walk through when we go to our next segment. For now, I'm just talking about the areas that trigger audit. Okay. In addition to that, this one is big, and it's the one where you misclassify your workers, where you hire people and you're wanting to treat them like full-time employees, but you want to pay them as independent contractors so you can avoid paying payroll taxes. Let me tell you guys, which number is this? This is my number 7. Let me tell you something. This area doesn't just get you into trouble with Uncle Sam. Even the state agencies, the state employment agencies, they are the worst. Like, they will come for you. So when I'm talking about being audit proof, it's not just for the IRS, even the state. Because when you hire someone as an employee, there are stipulations as to that, right? Which means this person shows up at a place that is designated for them to work at a certain time. You're paying them a certain amount. You give them the laptop and the things they need to work with. So here they are. You control their schedule and all these things as an employee. But you want to treat them as an independent contractor by not doing the payroll taxes, not giving them any benefits, and those kind of things. So when the state discovers it, or the IRS, there's a lot of trouble that could come for you. So definitely an area to look out for, okay? Another part is when you do very large charitable donations. Now, nothing wrong in being kind. But I remember doing someone's tax once, and this they did not know. This is not on them, by the way. They came from a previous preparer and they committed fraud on their stuff, and then they got a letter from the IRS and they didn't even know. And so when we pulled up the transcript, this person only made like 40 grand. And the preparer said they did cash donations of $26,000. Even the client was shocked. So yes, certain donations would definitely raise an eyebrow, like an eyebrow. Like, wait, what? You can't make 40 grand and donate 26,000, right? Like, what did you eat? How did you pay your bills? And that's why, guys, please be careful who you go to file your taxes with. It's very important that you go to people that are going to do right by you. Because when you get audited by the IRS, I'm telling you, some of these things are not fun. You end up paying so much money back that you shouldn't have. I'm not saying errors cannot happen, right? I mean, sure, nobody's perfect. Errors can happen. But when you have someone committing actual fraud and they are using your name and that's your tax return, and the IRS is going to hold you. By the way, when the IRS comes for you, forget your preparer. You're the one who is liable. You see? So you want to be careful who is handling your taxes. That's extremely important. Okay. So yes, large charitable donations can easily cause a trigger as well. And then my last one that I have, I mean, there are many others, but I think I touched on the vehicle. Oh, well, the last one is travel, and I kind of grouped this. Oh, yeah, I talked on vehicle already. My last one is travel. So I'm one of those people. I'm sure if you watch one of the episodes before, I am a big proponent of combining personal travel with business. So part of that can be deductible, but you have to do it right. This is not something for you to just lie. No, what I mean is if you decided that you were going to travel, maybe go on a vacation, this is where, we talk about all these different strategies where if you brought in some of your family members to serve on your board of directors, you could actually hold your board meetings during one of your travels. You could actually do a strategy session, or you can book events in that area. Like you can go and attend educational events or business events during the time of your vacation. There are things you can do that can move you forward in your business, that can, so long as you can prove that it's going to help move your business forward, part of that travel can be deducted. See, but here's the thing, you have to document it right. You have to explain the purpose, of that, of what you did. I mean, what you did, why you did it, and how it's going to impact your business, and document it right. And it doesn't mean you're going to write off the entire travel too. I think I've explained to you the ways you can do it so you can leverage this. If you can buy some of my books, so I think I covered that a lot. But for now, I'm just saying these are areas that can trigger audits because people try to play with this a lot. So you're not going to tell me that you and your family decided to fly to Europe and go enjoy a nice trip over there for $25,000, and you tell the IRS it was a business trip, but you didn't go for any conferences, you did not have any business meetings, you're not trying to invest in anything over there, and you expect them to give you the write-off, right? Now, if while you're in Europe, you decided to explore partnership opportunities, business opportunities, expand your business over there, then you can document some of those meetings, how much time it took, what was discussed, what was the decision arrived at. Now you have something to work with where part of your travel can now be deducted. But you have to keep that in mind, all right? These are just a few. There are many others, but these are just a few of the ones that normally will send a big trigger. Please hear me out. I'm not saying you should not write off your legitimate expenses. I'm just saying, even while you do, I want you to be audit proof, which means have the documentation, get to explain the what, why, when, how, how much, right? We need to have all of those things. It's not enough. Like we talk about meals are always a good area too. Like if you went out with someone and you guys talk business, it's not enough to just have a receipt that I was enlarged. Okay, who did I meet with? What did we discuss, right? I gave the example of the person who made $2,000 and said they took out clients for 25,000. Well, you never know. Maybe they went out with Tony Robbins. You never know. But the thing is, if they don't have a receipt to tell us that they met with Tony Robbins and this is what he ordered, some very expensive items, the IRS would definitely be disallowing that deduction. So that's what this is all about. Okay, really making sure that you have the documentation. So if you ever got into that situation where they were auditing you and asking for more, you're not losing sleep. Okay. So now let's talk about it. What does this audit proving mean? Like, what are the things that you should do to make sure that you are in a safe place? Again, remember, there are a lot of people that will never get audited. If you do your stuff and you don't fall into any of these categories, you might never get audited. You could still get audited. It doesn't mean you did something wrong. So you could still do everything right and get audited. Our state, generally would ask people for more information when they report something new. Like if you report a new business, sometimes they would ask you for more documentation. Doesn't mean you did anything wrong. You just have not reported that before. So that asking for more documentation, which we use the term audit, doesn't mean you were in the wrong. So the only thing that will help you out of this without you losing sleep is you having the right documentation preserved. All right. So let's go through my little list here of what I prepared. All right. The first thing when it comes to audit proofing your business, please separate business and personal expenses. Hear me out, guys. You see this? It will give you more peace of mind than anything else. Because when you separate your business from your personal expenses and you have a specific business account you use, your specific business credit card, it makes it a lot easier for you to do your accounting or your bookkeeping and have everything in one place. Okay. Now, sometimes as a business owner, we run out of money and we have to use money from our personal accounts. The best thing is you want to transfer the money to your business account and document it. Okay. If let's say you paid for something out of your personal credit card, you also want to document what that was if you did it on behalf of the business. Okay, so you just don't, even when you separate it, I know sometimes, now my hope is you don't have to be in this situation, but small business owners go through rough times, and there are times when you might have to pay for something and your business account is not happening in that moment and you have to use your personal account. You just make sure that you document it. Okay, now if you were to pay for something from your business account that is personal, you want to make sure it's a draw. Okay, because it's part of your owner's draw or however your agreement is, but make sure that it is also well documented that this is not a business expense, it's personal. So right off, you guys, if you're starting your business, if you're new to business, if you're a seasoned business owner, please make sure that you separate your business and your personal accounts. Have a separate card for business, separate account, and let everything business flow from there. If you pay yourself a salary, let it be well documented. All right, that's my first one. Second one is for you to keep timely records. Now, this is important. Why did I say timely? If I drove, let's say, 1,000 miles to Boston to meet with a client and I came back, the day I went and came back, it's a lot easier for me to document it on that day. If I'm keeping a time log, I drove to Boston. This is how many miles it was. I met with X, Y, and Z client. These are the things we talked about, blah, blah, blah. I'm done. This is good for you because if you were getting audited and then you woke up the night before and you're trying to create a mileage log, guys, that's gonna be brutal on you, and there's a high chance the IRS is gonna throw it out. Okay, because are you really gonna remember everywhere you went to? So it's very important that when you're tracking records, you just don't wait until the end of the year. Let it be something you're doing on a very timely and consistent manner, because that's how you're able to get yourself out. If I have clients that use diaries. Not everybody. I mean, if you're looking at mileage, for example, and I'm going to talk about that, use an app. There are many apps for that. But if you're someone who uses diaries, then that's a good one. If you went out to lunch with someone, you want to document it on time. You see what I'm saying? Because when you're able to document stuff on time, there's a high chance you will get it right. You'll be able to have all the information you need without thinking through or forgetting. All right. So there you go. Make sure that it happens on time. Next one I have here is always to write the business purpose. So it's not enough to have a receipt. It's also necessary that you write the purpose of that expense. Okay, I kind of touched on that earlier, but just keep that in mind. So if like I talked about, if you paid for something cash and you just have a physical receipt and it's not showing up in your bank statements, make sure that you're documenting that on that receipt. You have what you purchased, and how is the business use of that. Because sometimes people think because I paid for stuff from a business account, it should be assumed it's business related. No, you can still buy some stuff and it's not relevant to your business. But if it is, then you want to show that. Okay, so whether you're paying for that cash or even paying for that from your account, certain large transactions or certain purchases you make, you want to be able to document the purpose, the business purpose behind it. Same like I talked about travel, you want to talk about what you did that was related to your business in that travel. Okay. The next one I have for you is, if you are hiring your kids, please do it the right way. I'm already very passionate about that. But I want to talk on this because we usually have clients come and like, I heard you talk about this strategy. I even got your book. I have to claim my kid, but they don't have any track records. So please make sure that you're keeping timesheets. If you've gotten my book, Hire Your Kids, Save Taxes, Build a Legacy, you want to make sure that you are documenting the work that they've done, and you're also making sure that you can track their payments and money is leaving business account to the account that you save for them. That's my fourth one for you. It's very important. You want to have those timesheets. You want to have the payment method that was done. Because when you don't have these things or job descriptions, when the IRS comes to audit you, I should have put this kids part too. But it's just a lot of people don't use it. But it could also trigger an audit. You want to make sure that you have these documentation. Okay. Then the next thing is for you to use an accountable plan. If you're an S corp, or if you're in a partnership or C corp where you get reimbursed for your expenses. This is important. Now, what is an accountable plan? If you're an S corp, for example, right? If you last week I talked about S corp. An S corp is an election that you make with the IRS. You're telling the IRS that I want you to treat me and my business as separate. So in that light, your business can hire you and pay you as an employee. It's a deduction to the business, but you're still an owner of the business. So you still get your draws, the profits come to you for the risk that you take. However, because the business can hire you and pay you as an employee, you will normally save on self-employment taxes, where your total profit would have been taxed self-employment taxes before income tax if you had just filed on a Schedule C. So becoming an S corp has its benefits. Now, one of the things now that happen when you're an S corp is you're now an employee of your business. So expenses that you normally would have just reported on a Schedule C, like your home office, your use of your personal car for business, you can't do that anymore just directly. Your business gets to reimburse you for some of those out-of-pocket expenses. Okay. So if you have a home office you use for the business can reimburse you as an employee, because you as the employee cannot write off certain expenses on your personal taxes. But the business can reimburse you for some of those things that you have expenses you incurred to be able to do the work for the business. All right. So that's why if you have like a car that you're driving and you 50% of your mileage is for the business, your business can reimburse you for that. So you want to have an accountable plan that documents the different expenses that the business is reimbursing you for, how often you have to invoice the business, how much the business reimburses you for each of these items, and how frequently the business does that. Okay, when you have this accountable plan, it really takes away a lot of the guesswork or confusion that could happen. So if the IRS ever came to audit you, these are all the different expenses you get audited, you get reimbursed for, and boom, peace of mind. And let me tell you guys, I'll tell you, that's one of my favorite reasons why anyone should consider becoming an S corp. Okay, like those reimbursable expenses where it's like, you're getting your money back. But I'll talk about that another day. I mean, the S corp is such a great tool, with such a great tax entity structure. Not for everybody, but for those that can benefit, it's incredible. So you remember we talked about, like, this is where you can rent your home to your business, because now your business is separate from you. You can rent your home to your business for up to 14 days, right? You get your business gets to pay you for those 14 days of using your home. Your business also gets to write off the deduction. So you are getting paid, and because you it's not over 15 days, you don't have to report that income, and then the business gets to report the expense. Such a win-win for everybody. I mean, S corp is just, yeah, it's an amazing entity structure for tax purposes. May not be right for everybody, but always something to consider if your business starts becoming really profitable. Okay, so let me move to the next one. Another a big one now is compliance with state as well, especially when it comes to things like employment. I already mentioned earlier that people, look at my notes falling. I already mentioned earlier that people sometimes mix up who an employee is from who an independent contractor is. So you want to have clarity on that. You don't want to treat an employee as an independent contractor just to avoid paying them, taking out taxes, paying payroll taxes, or offering them benefits. If you're hiring someone and you cannot afford, okay, to bring them on as an employee, make sure that that's clearly stipulated in your contract. Make sure that they are very aware that they are coming as an independent contractor. They are liable for withholding and sending their they are responsible for withholding and paying their own taxes and sending it to the IRS. It's not your responsibility. They have flexibility with their schedule. They can get to make their schedule. They can get to use their own laptops. They can get to use certain personal stuff, and even be more flexible with when they show up or where they work. You need to have these things clearly defined, because if you hire someone and treat them as an employee yet pay them as an independent contractor, the state, the IRS, probably even your industry might come for you, and it's never fun. So you want to make sure that we have that set up, okay? And then you have things like sales tax as well. Those are some of those compliance things that I want you to make sure you're documenting them right. If you collect sales tax is not part of your revenue. You do not own that money. It's money that you're collecting on behalf of your state. When you collect that, you want to remit it as soon as possible and have a process for that. Have a process and have all the documentation of the sales tax that you're collecting and remitting back to the state. If you sell across multiple states, get to understand what the legalities are for Nexus, right, where you're paying sales tax to other states as well. So you want to understand some of those things. And then you want to also make sure that you're compliant with your annual registration. Your annual registration is what you pay to your Secretary of State for keeping your entity structure active every year. So these are very important. You want to keep those documentations, okay? There are people that have gone to apply for grants and realize, and I'm talking grants for businesses too, realize that they were out of status. You don't want that, okay? These are all things that can cause you to get audited. Funny enough, right? Even by the state, bring you issues. And then the next one that I have is for you to have, this is my seventh, have enough documentation for the high audit items. So like your home office, I talked about travel and your car, use of car. So for your home office, what I want you to do is I want you to make sure that you measure the exacts that you use exclusively and regularly for your business. Now, you cannot tell me that because you took your laptop and you worked on your kitchen table, that's your office space. Office space is a space that is designated exclusively for you to do work for your business, which means we cannot use this space for personal stuff. Now, does it only have to be in one corner of your house? No, it can. You can have an office space where you work, but you can also have another corner of your house where you prepare, where you save documentation of files or products from your business. When you add those up, those will all add up to your office use of your office, your home office. All right. Now, when you add that up, you want to have it documented. You want to make sure that it's used exclusively for business. Then the other things now that you want to see have is the total square footage of your home as well. That's usually easier to have because when you're calculating your home office expenses, you're going to take the square footage of your office divided by your total home office, total home square footage, and then you multiply that by your utilities and other expenses. Okay. So what's another thing you need to keep? All the receipts, all the bills for your home utilities, your mortgage or your rent, all of those things that you use when you're calculating your home office. Okay. Now, if you're worried about the home office, you can always use the low hanging fruit where you do $5 per square footage up to 300 square foot. That's 1,500. It's not bad if you're not sure about tracking these, keeping all these other receipts. Now, for your car, please track your mileage. Okay, these are the top three areas that in my books you want to have enough documentation. Mileage is a big deal. There's so many apps right now. There's My IQ. I don't even, if you're a person who drives for business, you should have My IQ or there are a couple of them. MyIQ is easy because a lot of our clients use those, but it really helps you to keep track of your bit. Once you get in your car, you just turn it on. It's tracking all of that for you. You want to have that, but also sometimes, not just sometimes, but have the purpose of that trip documented. Okay. Now, when you're reporting your auto expense, you always do one or another. You either do mileage or you do actual expenses. Actual expenses now are things like your gas, your insurance, and those kind of things. And you do that in relation to how much of your car is used for business and how much is used for personal. So if 50% of your car is used for business, then 50% of your gas, 50% of your insurance, and all these different things will be applied to your business. Now, sometimes using the mileage might be a better deduction, right? Because miles go up every year and it's incredible. So if you're getting 70 cents per mile that you drive for 10,000 miles, that's $7,000 in business deduction right there. But what do we need you to do? Document, document, document. Same with the travel. I already kind of hinted on that. Oh gosh, look at the time is going. You want to make sure that you're writing the purpose of your trip, what you did during that time. Now, here is my trick, okay? Here is my trick. And you need to have it well documented and have legit stuff. If I were traveling for business, or if I had like a conference, I would definitely want to make sure that my conference would fall like on Friday and on Monday. Why? Because then I don't have a choice. I have to stay over. So if I travel on Thursday, which the day of travel is already included, and I'm coming back on Tuesday, I have a conference on Friday and a conference on Monday, then I'm supposed to stay the weekend. That's a full business travel. But if I find my situation where my conference ends on Friday, then Saturday and Sunday, me choosing to stay is personal. So I cannot count all of that now as a business expense. So you have to make sure that these things are well documented and you allocate the right expense to your business. Fair? Okay, good. So I'm almost going out of time. So the next thing, eighth one, is please make sure that you file and pay your taxes on time. But even better, file an extension if you're still struggling to get your records right. The worst thing for you to do is to rush to somebody and then they just put fictitious numbers on your taxes. You want to avoid that. You can always pay an estimate ahead of time while you take yourself you get an extension to give you 6 more months, so you have enough time to go through your records and make sure that everything is well documented, you have the support, and then you file. All right. And my last one for you is please keep your records at least from 3 to 6 years. Now, the minimum is usually you have up to 3 years for the IRS to generally audit your taxes, but there are exceptions. If you underestimated your income by 25% or more, the IRS has up to 6 years to audit. Now, if there was any criminal stuff involved, there is no time limitation. They will come for you. So this is what I always suggest. Please keep your documentation for as long as you think is relevant. Preferably 3 to 6 years, but even more. I've seen situations where someone could have been married to a spouse who was doing something funky in their business. In that situation, I will keep the documentation for a long time, especially if you're no longer together and down the road, IRS was like, hey, show up when you guys had that partnership, what was happening, okay? Or if you had a business partner and you guys split apart, but maybe the business partner was still using your business name, I will keep those records for a very, very long time. Just something to keep in mind, okay? So I think I got everything in, you guys. And of course, if you need help with having a good bookkeeping system in place, please come to us at the ARC. We're more than happy to help you with that. Having a good bookkeeping system in place is incredible. I promise you, not only do you get to file your taxes early and on time and stay out of trouble, but you can also plan, you can also strategize. When you come to me, like right now we're going into our second quarter tax strategy meetings. When you don't have accurate records, I really cannot help you. But when you have accurate records, then I can help you a lot, okay? So if you need a good bookkeeper or good bookkeeping system, we'll be more than happy to help you at the ARC, all right? So let's move on now to my favorite topic, partnerships.